How do you make sure that your portfolio, your stock portfolio, will only have shallow dips and the time to recovery will be rapid? Now, this is something which in the hedge fund industry, when we're pitching for capital, it's an important thing to get across to clients, that how deep are the drawdowns, in other words, from peak to trough, depth of drawdown, and how quick is the recovery, the time to recovery typically. And of course, as you can imagine, if you were to run some numbers, then you could probably calculate the kinds of portfolio or the things you'd want in the portfolio. You certainly wouldn't want everything to be correlated, because then the depth is likely to be accentuated and the time to recovery would be in the hands of the fact that it's correlated. Just effectively one big stock is all it is. So to make that shallower, there's several things you can do. First of all, of course, correlation is one thing. If all other things are equal, you want to try and avoid things which are all highly correlated to the broader market, because then you're just, as I say, buying one big stock. Now, of course, when the markets fall, correlation increases to the downside. Here's a few other things that can be done. One thing, and popular again in the hedge fund industry, is something called the Sortino ratio. Okay, the Sortino is a measure of your average return, and of course you want that to be as high as possible, and the volatility or risk of missing that. So in other words, how consistently are you hitting your high returns? That's what it measures. And if you think about it, a drawdown, it shows a lack of consistency, and a deep drawdown shows an extreme lack of consistency, and a deep drawdown which takes a long duration, notice the D's, drawdown, duration, depth, takes a long duration, also shows a lack of consistency. So a high Sortino should help. The other thing is alpha. What is alpha? Well, if the markets go up, you should go up more, so less likelihood of drawdown anyway, and protection from drawdown. But more importantly, when the markets fall, you shouldn't fall as fast. So your drawdown depth should be lower. Now, in and of itself, it doesn't tell you anything about rebound time for duration. That's where the Sortino comes in. So you want to try and mix the Sortino and the alpha and have those relatively high. Of course, just in absolute terms, having a low volatility, so avoiding the pinks, would assist as well. Correlation is over there. Ideally, don't have things which all look very correlated to each other. In the old days, people used to use as a proxy for that the sector or the industry, or the index, or the industry, or the currency, the country a stock is in. Well, actually, just look at the number. You can be in different industries in different countries and still be highly correlated for a whole host of reasons. For instance, you might be a major supplier to Costco, and you might think, well, surely you're in retail. No, one's an institutional supplier, the other one is selling to retail. So there can be correlations which, looking just at words like the industry or the sector or the country, won't necessarily assist on. Even exchange won't necessarily assist on. Beta is an important one. We want to make sure we've got alpha. Beta is basically, if the market goes up, you go up more. If the market falls, you fall further. So it's just another form of leverage, effectively. Now, beta can vary. But on the whole, you want to make sure your returns are not just coming from beta, because then you could have just leveraged it. There's no alpha. There's no outperformance of the index. If it's just high beta stocks you've picked, then you're actually just getting lucky while the market's rising, and you've got a problem when it falls. And you usually don't want high beta, because then the market falls, then again your drawdowns are going to be that much deeper, and they're going to be for a longer duration. Now, if that all sounds like gobbledygook, forgive me, but I just wanted to dive a little bit deeper into some of those things. See that book over my shoulder, Investing Unplugged? You can download a free copy of it from alpeshpatel.com/links. Thank you very much.